Hello everyone, welcome to the channel. A lot of traders lose money trading the financial market because they lack proper understanding of the liquidity concept. If you don't understand what liquidity is, you're going to end up becoming a liquidity in the market. And this is what we try to avoid. We want to maximize profit and minimize losses. So in this video, I'm going to teach you all you need to know about liquidity so you can be well positioned to take advantage of the opportunities that the market presents. So without further ado, let's dive into the video. So what is liquidity? Liquidity simply means money, right? It means money. In the market, we refer to liquidity as the buy orders and the sell orders, right? Now, when the market is trending this way, when the market is selling, right? When the market is selling, we have our stop losses here, right? We have stop losses at each of these highs here. At each of these highs, this is a stop loss. This is also a stop loss. Now above this stop loss here is liquidity, and above this stop loss here as well is liquidity as well. Now, when the market is trending upwards this way, right? Now, below each of these low is somebody's stop loss, right? So that's liquidity, somebody's stop loss. It means if the market decides to take out this liquidity, a trader somewhere has lost money, right? And that's liquidity. That person has become a liquidity. That person has provided liquidity for the market. And this is why there is no strategy in the market that is 100% because every trader will have to be a liquidity at some point. So you're going to have to lose money at some point as well. Just that what we try to do is we try to maximize our profit and to minimize our losses. This is how we stay profitable as traders, all right? So when this happens in the market, we say liquidity has been taken. When price comes down this way, right? Liquidity has been taken. So each of the lows you see in the market and each of the highs you see in the market beneath those lows and highs, right, are liquidity. Now we have different type of liquidity. And also, you need to also note that liquidity is what moves price, right? Price will not move. A market where there is no liquidity, the price will remain at the spot, right? The price will not move. But once liquidity is introduced to that market, either to the downside or to the upside, it will start creating higher highs and higher lows, right? To the upside and to the downside, higher highs and higher lows, right? If there's liquidity. Now, a market that lacks liquidity or have little liquidity will be moving this way, right? The market will be moving this way. We'll be creating, we're moving in the range, moving this way, right? And when this happens, we say that there is low liquidity in the market. So you would want to trade a market like this. You want to trade this type of market, right? That is trending to the upside, right? Now, so what are the types of liquidity? We have different types of liquidity. The first one we are going to look at is called resistance or support liquidity. Resistance or support liquidity. Some persons call it double top or double bottom, right? Double top or double bottom this way, right? They call it double bottom or triple bottom, whichever, right? It could be double, it could be triple. All of these are support liquidity. I just like to call it support liquidity, right? So when you have something like this, let's make this one double, right? Now, this is a resistance liquidity. Now, this high here, above this high here is seller's liquidity. Now, whenever you have this type of liquidity, whenever you have this type of structure in the market, it means above it is high liquidity. Why? Because a lot of persons are going to be selling from this zone. Some persons will be anticipating that price is going to come back here again, and you know what, and then sell to the downside, right? So a lot of traders are going to have their sell positions stacked, right? And their liquidity will be lying at just above this high here. Likewise, the support liquidity as well. A lot of traders are going to be in this market and their stop loss will be just below this low as well, right? So what the market does is we have two types of traders, right? We have two types of traders. Now, before I proceed, we have two types of traders. We have the smart money trader and we have the retail trader. Now, the smart money, they are the big institutions. They are the one that moves price. They are the one responsible for this type of move you see here, right? All these impulsive move. They are the one moving price, right? And also we have the retail trader. The retail trader is you and I with our $100, our $1,000, $10,000, $100,000, even $1,000,000, right? We are referred to as the retail trader. The smart money traders, they come into the market with billions of dollars, right? With hundreds of millions of dollars. So when they pump money into the market, they pump liquidity into the market, it moves price. So whenever they want to get into the market, they look out for this type of liquidity. So this is what they will do, right? This is what they will do. Remember, this zone here is acting as a support, right? And here is acting as a resistance. So this is what they will do. They would want to take liquidity from both parties. You know, in a market like this, both buyers and sellers are trapped in this market because one party is saying price is going to break out to the upside. One party is hoping, the buyers will be hoping that price is going to break out to the upside, and the sellers are hoping that price is going to break down, right? So both parties are trapped in this market. So when the smart money guys come into the market, this is what they will do. They would want to, take liquidity from this zone first, right? They'll take this liquidity. When this happens, once price break out of this resistance zone, we say there is a breakout, right? Now, once this breakout happens, those persons that were selling this price, they are going to have a new bias. They are going to be like, okay, since price has broken out of this resistance zone, it means price is now bullish, right? So they are going to look for the next element of the element of price that sponsor the break of this structure. And probably most of the time is order block, right? They are going to use order block. So they are going to, mark this order block that was responsible for this breakout. So they are going to come and place their buy position here as well. So everyone is now in the market, both the buyers that were holding their positions, the new buyers that are coming in, which were formerly the sellers, right? Everyone will now be in the market. Now, then this is what they will do. The smart money guys now would then push price to this order block, right? Everyone will be tagged in, everyone will be on the trade, right? And then this is what they'll do. Some persons that will be waiting for confirmation as well. The market will give confirmation, maybe just give one push, to the upside this way, and then boom, take everyone out. So by doing this, they have taken liquidity from the upside and even the downside as well, right? So this is how the smart money guys take this type of liquidity. Let's quickly go to the chart and see if we can spot any example. Okay, let's look at a good example here. Let's consider this zone. Look at this zone here. Look at this zone here. This is if you agree with me, this is a resistance zone. By the way, if you don't know what resistance and support is, check out my last video. I made a comprehensive video about resistance and support. And guys, also, if you haven't subscribed to the channel, please go ahead and click on the subscribe button. And also, please like the video just to help the channel, all right? So this is a good resistance zone, right? This is a good resistance zone. You can see how many you can see how many times price already, interacted with this zone. The first time, the second time, the third time, and the fourth time. Now, so traders are going to, there are lots of sellers now within this zone, lots of sellers. The sellers that got in with this first rejection, the sellers that got in with this second rejection, this third rejection, and even this fourth rejection. Now, their projection will be that price is going to take out this low, right? After all, there was a breakup structure here. There was a BOS here, right? There was a BOS here. So they believe that this is still a selling market. That this is a BOS, right? This is a BOS. So they believe that this is still a selling market, right? And they are anticipating that price is going to what? Price is going to come down to create a new breakup structure to continue the trend, right? This will be their projection. So let me cut price so we can see what happened. Let me cut price. So this will be their projection, right? That there will be a new BOS here. So what are they going to do? They are going to place their sell position here at this zone, right? They are going to place their sell position here. They'll be tagged in, right? And waiting, and this will be the target, right? For price to create a new low. So let's play price now and see what price did to them. Price is going to give them some. Okay, look at that. Just look at that. Price already took them out, right? Price already took them out. Now look at what. Now after this happened, this is what I just explained to us. After this happened, now there is a clear breakout now. So the buyers, everyone that was topped out here, the sellers, they are all going to have a new bias. They'll be like, okay, this is the other block that was responsible for the breakout. So everyone is going to jump on the long as well. And remember, there were existing buyers here, right? This was our support zone. Remember, this was our support zone. This was our support zone, right? So there were already existing buyers in this trade, right? Plus the new, plus the sellers that are now in the buy. So everyone will now be taking this buy because there is a breakout, which is an indication that price is going to what? Is going to buy, right? And then the target, the take profit will be this high. But look at what price did. Let me play price again so we see what price did. Price reacted for now so beautifully, giving everyone profits. But look at what happened afterwards. Boom, boom. You can see that. You can see that. Price already took everyone out, right? So this is now for those that were selling, that was selling, this is more like double loss for them, right? So you can see how this liquidity works. So now the next type of liquidity we'll be talking about is called trend line liquidity, right? Trend line liquidity. Now, what is a trend line liquidity? Trend lines are, diagonal lines like this. Okay, let me stop price now. Let me stop price from playing. Now, whenever it is called trend line because it is used to mark, the continuation of trend or the line of trend, the higher highs, the higher lows, and all that, right? So whenever we have the market trending this way, you want to, mark out your lines, expecting that price, you mark out the first two touch, right? Mark out your first two touch, right? You must have at least two touch on the trend line, right? So you mark out this line and you mark it this way. So you can see that price came to tap into this zone. So anybody that trade trend line would have, taken an entry from here, right? Upon this third touch, and then, their stop loss will be here. Let me just cut price so we see. So this will be somebody that trade trend line, right? This will be our projection. Remember, we'll draw our line connecting the two lines, right? And then we'll draw it this way, connecting. Now, our anticipation is that price is going to come back and tap and touch this line again, right? So whenever price comes to touch this line again, we would look for a buy, right? And our stop loss will be just below this zone here. So let's play price and see. So boom, price already tapped it, and you can see that. And then our target will be this high that was created, right? This high that was created. So that would have hit our target already, right? Now you can price can actually tap this zone multiple times, right? But if price keep tapping this zone or this trend line, the higher the number of touches, the weaker it becomes, right? The weaker it becomes, and price is going to eventually break it because it is liquidity. You can see that already. Price already took it out. You can see. Price already took it out because this is now liquidity. Why? Because a lot of traders are going to be, waiting again for price to come here and tap, right? So they can take a trade and then their stop loss will be somewhere here or wherever, or maybe they just place their stop loss somewhere, right? And you can see price already took out the trend. Some persons will even place their stop loss, high, right? Because the higher the trend line is going, the higher their stop loss as well, right? So you can see price already broke the trend line. And so this is how trend line liquidity is taken. Let me see if I can see a clear example of a trend line again. Okay, this is another trend line, right? You dragged it. See another trend line liquidity here, right? This would have been a good trade as well because price already tapped it the first time, the second time, and then it came to tap this the third and the fourth time, right? So this would have been a good trade, trading the trend line liquidity. Now, what the smart money guys will do is they eventually come back and take out this trend line, right? They take the liquidity out. So whenever this happens, we say trend line liquidity has been taken. Now let's move on to the next one. The next type of liquidity is called inducement liquidity. Now, this is very, very important because a lot of traders tend to make mistake with this trend line liquidity. Okay, let's look at this example quickly. This is a trendy market, right? This is a market creating lower lows and higher lows and all that, lower lows and higher lows, right? If you look at this scenario very well, look at this last break of structure. So this will be each of these will be our BOS, right? This is our BOS. This is our BOS, right? Now, this is the zone that was responsible for the BOS, right? And in this scenario as well, this is the zone that was responsible for the BOS. Now let's consider this zone here. Let me cut price. Let me cut price. Now, if you observe this last break of structure, because some persons are going to mark this zone as their next BOS, and they'll be anticipating that okay, price is going to come somewhere here and then continue to sell, right? To create a new low, But oftentimes it doesn't happen like that, right? Because this was the last place we have an impulsive move. Look at this move down here. Just look at this candle that broke this structure. You can see how impulsive the candle was, right? Now look at the candle that broke this this low here. It wasn't an impulsive candle, it was just a regular candle, right? But look at this one. This is not a regular candle. If you look at this zone as well that broke this low here, right? The candle that broke it is not a regular candle, right? It is a very serious candle, right? Also, if you look at this candle that broke this low right here, is also an impulsive candle. So in this type of scenario, right? When you see this type of move in the market, you know that this zone here that was responsible for this impulsive move downwards is actually the liquidity zone, right? There is an order, there is a sell order stacked here. There is a huge sell order stacked here. So you're going to anticipate that price is going to eventually come back to this zone and then, before the sell-off, especially when the preceding break of structure was not by a strong impulse. You can, just like this one that I'm talking about, this is not a strong impulsive, right? So you already know that price is going to come back to these last impulsive zones. So before price come here, this is what price is going to do. Price is going to start creating inducements. Price is going to start creating a lot of liquidities this way, before eventually get to this zone, right? So that it will give buyers once price takes out this high here, right? This little high here, if buyers are going to jump into the market and they are going to think that, okay, there is a change of character here, right? And they will expect price to take out this high. So they want to, price to take out this high, right? But that's not what will happen, right? That's not what will happen. But look at let me just play price now. You see what I'm talking about. Just look at what price is doing, creating series of liquidities, highs and lows within this zone here, right? You can see the lows and the highs. And it will give buyers impression that, okay, price is now bullish, right? Because it's creating series of higher highs. And look at what happened. Price just came and tapped it, right? So this will be our sell, we'll place our sell position here. And that would have been a good trade, right? That would have been a very good trade. And would have gotten maybe our 1:3, our 1:4, our 1:5 from this trade already, depending on what our target is, right? So this is how inducement is created. So all of this liquidity you see here, all of this liquidity, right? All of this liquidity around here are all inducement liquidity, right? They are inducement liquidity just for price to respect this zone. If there was no inducement liquidity and price just move impulsively towards this zone, price would have taken this zone out, right? So since price wants to respect this zone, it will go ahead and create lots of inducement before it will eventually sell off, right? Now, the last type of liquidity we'll be talking about are the daily highs and lows, right? The daily highs and lows. Daily highs and lows. That's the last liquidity we'll talk about. Now, how does this happen? Now, if you want to get where the liquidity lies for a day, what you do is you pick your this vertical line, and then when you're moving this vertical line across your chart, you're going to be seeing the dates and the time, right? So let's mark 22nd of January. This is 22nd of January. Let's also mark our 23rd of January, 23rd January. That this is 23rd 00. Whenever you see 00, that means it's a new day, right? Now, where is 24th? 24th 00. Okay, this is 20. Okay, yeah, this is 24th. So this is the last 3 days, right? This was 22nd to 23rd, and this is 23rd to 24th. Now, whenever price create a low, right? Price always target the previous day low. The low of the previous day, price will always target it. Now look, this was the low, right? This was the low of 22nd to 23rd. This was the low, right? This was the low. Look at what price did in the new day. Price came and took out the low. The new day, price took out the low, right? And look at what price did again that same day. Now, this is the high of the 22nd, right? This was the high of the 22nd. Look at what price did. Price eventually came and took out the high, right? Now, so below this low here, right, of the new day is liquidity. Now, below above this high of a new day is also liquidity. So it means that this is the low of the 23rd, right? This is the low of the 23rd. So this is liquidity. These are people's stop losses. Lots of traders have their stop losses here, right? So market is going to find a way to also come down, and take out this liquidity as well, right? And it's also going to find, depending on where the market closes today, if the market keeps making highs and highs and highs, when the market, today is Friday, right? I'm recording this video on the 24th, Friday. So when market resumes on Monday, right? Market is going to find a way on the new day. Now, market is going to find a way to take out the high, right, of the new day, of the previous day. It's going to take out the high, then eventually find its way down to take out the low, right? To take out the low, right? So this is how market takes liquidity. So each of the high of the day or the low of the previous day, sorry, the high of the previous day and the low of the previous day, they are all liquidity, right? So whenever you're taking your trade, you want to consider each of these liquidity zones. And now this is how you trade. This is how you trade it. Let me show you how you trade it now. Having understood what the daily liquidity is, now how do you trade it? If you want to trade it, you're going to have to mark out the zone, right? The low, for example, just like I mark out this one, right? Now what is my anticipation? I'm going to anticipate that whenever price comes to this zone, price is going to buy from this zone, right? So I'll push my stop loss down a bit, and I'll place my buy order just below this low here, right? Also, likewise, if I want to, just like look at this zone, for example, this would have been a stop loss trade, right? So I'll place my high above here, and then I'll push my stop loss a bit. This would have been a stop loss trade. But whenever you're trading this type of market, you don't just trade both sides, right? So this would have been a stop loss if you try to trade it both sides. What you do is you try to identify the trend. For example, you look at GBP. GBP is buying, right? So since you understand that GBP is buying, you will be looking to take trades from the low of the previous day, right? Because you know that GBP is going to continue buying because it's on a bullish run, right? So this is how you trade the lows and the highs of previous days. And this is where, so support and resistance liquidity, trend line liquidity, inducement liquidity, and our daily highs and lows. These are the four major liquidity in the market, right? For the basic liquidities in the market. So guys, I need you to quickly answer this quiz, right? And show me your answer in the comment section. I would respond to your answer, all right? So just quickly answer this quiz in the comment section. Guys, if you haven't subscribed to this channel, please go ahead and do so. And also like the video as well. See you in the next video, guys.